InvestorAid was launched in November 2022. July 2022 was when I met an accident. And services we offer, it's full-time buyer's agency service and negotiation only service and auction bidding service. 99% of our business is full buyer's agency service. We basically only work with investors and we only invest in freestanding existing dwelling. That's what we niche in. This is our team. I'm a buyer's agent. I've got my colleague Deepak working with me. He's here. I've got Harsh. So 75% of our buyer's agents are in the room. And then we have Friska, who's based in Melbourne. And then we have got a client success manager, Maggie, who's based in Philippines. And we have got Danica, who is a social media manager based in Philippines. So how to identify property hotspots before they boom? So see, making money in real estate is not complex. As long as you are following the right fundamentals and the strategy, you will repeatedly make money with each of your acquisitions. So there is no rocket science. We follow the same strategy, and that's how we are making each purchase successful for our clients. And the first question is, why invest in hotspots? The reason is that when you are investing in hotspots, you are essentially chasing a short-term capital growth, which means a capital growth in a shorter time frame. You can actually use that money, that gains, as an equity to buy another one to exactly do the same thing. And that's how you expedite or speed your wealth building journey. You time the markets and then you basically like fast-term capital growth and then use that equity to buy another one. And that's how you basically build and scale your portfolio. The heavy lifting for capital growth is done by market cycle timing for short terms. If you are looking to have short-term gains, you have to be definitely following the market cycle timings. The market cycle timing basically gives you the max, like 70% of the capital growth is attributed to that. A market timing beats property perfection. An average property in a rising market can deliver a far greater growth than a great property in a stagnant market. You are chasing capital growth here and timing the market correctly so that you have got best capital growth opportunity. Then how to identify growth regions? Market cycle timing is definitely a bigger one, but then you have to be also looking at the infra spendings by the federal and the state in the region so that you understand what the government is seeing as a future of the region. Then you also want to be focusing on the economic diversity of the region. Say, for example, everything else is tracking well, but if there is lack of economic diversity, that could be a risky market. You don't want to be relying on two markets, which has got just reliance on a single industry because that market just could be too volatile. Today, it might be giving you good gains, but it could also be subject to heavy correction if that industry takes a hit. And then definitely the population growth. And the reason is because whenever we are talking about price growth, whether in property or anything else in life, it is always a factor of demand and supply. So this tells you the demand side. If the population is growing, then the demand grows, and then obviously that leads to capital growth. Then once you have identified the region or the city that you need to be investing in, now you need to find the best suburbs in that region where you need to be investing in. You don't want to be randomly picking properties in the whole region. You have to be selecting 3 to 5 best suburbs to actually have the best capital growth opportunity. And when you are selecting suburbs, you want to be looking at mostly demand and supply data metrics. One of the very important data metrics is average days on market. It is an average of days on market calculated per suburb per month. So you want to see how average days on market has been trending for the last 12, 24 months to see where the market is expected to head. If the average days on market is declining, it means the demand is rising. You know what you can expect, and vice versa. Then stock on market percentage. This tells you the supply side of the equation. Stock on market percentage is the number of properties available for sale at any given point in time divided by the total number of properties in the suburb. The lower the stock on market is or the declining the trend is, it is favorable for you. Renter versus owner occupier. Very crucial. You want to be targeting suburbs with lower renter percentage because tomorrow once your property comes to the market for rental, it will have less competition. And also lower renter percentage means higher owner occupancy, which means the area is much more desirable. And because more and more people are committing to mortgages to be living there. Desirability is high, supply of rental is limited. That's what an investor wants. Vacancy rate. Definitely you need to be looking at vacancy rate because this gives you a clear idea of what you should be expecting when this property goes onto the market for rental. It will tell you whether it is going to be rented sooner or will take a bit longer. So demand needs to high, supply needs to be low, and that's what leads to capital growth. And then on top of that, you want to do on the ground due diligence. The reason why, for example, if the supply and demand fundamentals are very favorable, you want to understand the why behind those supply and demand fundamentals. So on the ground due diligence is very crucial. You want to be talking to locals and understand how people feel about the area, what they have seen in the last decade or two. So once you start talking to locals, that covers a lot of things that are unknown at this stage for you. When you are actually talking to locals, they also tell you how they perceive certain suburbs, because how locals perceive certain suburb will determine how far these suburbs can grow. And then you have to be visiting the location, the suburb in DNI to see how feel it saves, what the vibes are, and then also build relationship with the agents if your intention is to get access to more properties like pre-market and off-market opportunities. So data find deals, ground truth confirms them. The biggest three mistakes that investors make. Nobody wants to lose money in any investments, not just real estate. But majority of the investors never make money or enough money through real estate investing. And the sole reason is because they are following news, they are chasing hype. Hype basically means that a market has risen significantly, and then you are chasing that because everyone else has made money. And that could possibly be a bit too late. So remember, if anything is appearing on Google or any of the social media platforms, you are too late to the party. You have to be getting into the early phases of its growth to have maximum upside potential in the shortest time frame, rather than getting too late into the cycle followed by a bigger phase of stagnation or low growth. And then ignoring the market cycle timings. Like we just say, for example, every day, everyone that I'm talking to, every second guy is wanting to invest in Perth, Brisbane, and Adelaide because these properties have grown 150% in the last 5 years, which by itself is a red flag for us. So neglecting on the ground due diligence. Client success. I'll just quickly share one of our client success. For this client, we have done nothing magical. We have exactly followed the same strategy. We ended up buying 4 properties for this client in 9 months. It started from October 23 and the last purchase was done in June 24. The total equity this guy has made is closely touching $1.2 million. The lowest purchase price was $493,000 out of these purchases, and the highest purchase price was $610,000. The combined equity that he has made until this month is $1.192 million. 2 of these properties were bought in Townsville and 2 of these properties were bought in Perth. Again, followed the market cycle timing and nothing else. This guy has come back to buy 2 more properties now together under SMSF, which will be making a purchase. He's in the process of doing the rollover at the moment. And there are so many other stories. There are people in BNI for whom I bought 4 plus properties in last 2-3 years since we have started working. And this can only be achieved if you follow the previous slides thoroughly. And that's it. So if you know anyone who's looking to buy a property and don't know where to begin, or they have been struggling to secure something, and we would like an introduction. Thank you. I think we might have a minute or two. Any Q&As, more than happy to answer. Yep. Yes, very good points. I think the biggest challenge is when we start restricting ourselves to geography, we actually minimize the potentials because every market goes in cycle, and that is the biggest problem with local investors. Say, for example, if you are always investing in local geography and like usually market goes in a good phase of growth for 3 to 4 years, followed by 5, 6, 7 years of stagnation. If you are a local investor, the biggest challenge is if you're buying one property each year for 10 years, you're only going to be right 3 or 4 times out of 10. The other times you are missing out on opportunity. But if you become a borderless investor, in that case, whenever you're ready to make a purchase, find markets throughout the country where you can have the best potential.